We welcome in Joseph Shaposhnik, founder, portfolio manager, Rainwater Equity. Thank you so much for being with us. Folks are constantly looking for opportunity. At the same time, they may be cheering their 401k and IRA when they see records, but they start to wonder what's too frothy, what's coming next. What's your most recent market outlook? Has it changed at all?
Well, there's nothing wrong with being happy, especially on a Friday. But I think that the market is looking at where the Fed will go in the next couple of meetings. It's looking at really, really strong results from the Mag 7 and associated companies that are supporting the Mag 7. So my view hasn't changed much. We're obviously in an upward market. The market is expensive, without a doubt. So we've got to be selective with what we own and what we hold. But clearly the outlook is solid, and the underlying fundamentals of the S&P 500 are very, very strong. We're seeing double-digit earnings growth, improving margins, improving returns for the index, and a backdrop of potentially lower rates, which is going to be broadly supportive of a rising market for sure.
So the momentum is to the upside. That's the path of least resistance. But it's not just momentum. You actually truly believe that after earnings season, the fundamentals merit or are good enough for higher highs going forward?
I think so, because today the fundamental driver of the market is AI. And the latest data points on AI are universally positive. You just spent a couple of minutes talking about the Oracle results, and whether those orders turn into actual revenue is somewhat uncertain. But the fact that the orders are there and in large numbers continues to drive positive sentiment associated with cloud and AI, which today is fortunately or unfortunately underpinning the bullish move in the market today. What we would like to see is stocks that are the magnificent 493 participate and catch up to the growth and to the stock moves of the Magnificent Seven. That's not really happening. Magnificent Seven continued to outdistance the 493. For a more broader recovery that is probably more sustainable, it would be nice to see the rest of the market participate. But for the averages to go up, if the news continues to stay solid as it seems to continue to do, the market is headed higher.
I think about the big picture here in AI, and Sam Altman was actually noting, obviously, the latest deal that OpenAI has with Microsoft. We talked about OpenAI and Oracle this week. There's been a lot of news, but he also noted the AI, resurgence, or I should say revolution is a better way to say it, and that it's going to be a bit of a boom, and not everything like the .com era is going to survive. Are you worried that people are sort of buying across the board when it comes to AI and they may have some busts?
Well, it's a great topic. There will be winners and losers without a doubt. And so what we spend a lot of time looking at are recurring revenue businesses. And a lot of those businesses happen to be in the software space. Now, we find them in aftermarket aerospace parts. We find them in credit bureaus and in other areas. But in the software arena, certainly those software companies that have unique data and are mirroring that unique data with innovations on how to collect it, move it, organize it using artificial intelligence, they will have an advantage, particularly if they can reduce their costs of development and deployment with using artificial intelligence. Those that are on the back edge or on the back foot of utilizing AI, they're going to be caught up by emerging competitors that are developing AI models that can replicate what those businesses do and do it much more quickly and much less expensively than some of those software companies. So there definitely will be winners and losers from an economic perspective. But I think longer term, there will be consolidation among the AI vendors. And so we have to evaluate who those winners and losers are. Today, demand is outstripping supply. That may not be the case forever. So we're looking at those who are advantaged and less at risk in terms of what happens if demand doesn't keep outstripping supply.
Yeah, and I wanted to go over specific opportunities. I know you were a top TCW portfolio manager for the last decade. You went out on your own. You have Rainwater Equity and launched an ETF RW in June. You also have the backing of legendary investor Bill Miller. Tell me a little bit about this play for a portfolio. Why is that a good fit?
Well, look, we think that one of the reasons most actively managed funds underperform is because managers believe they can forecast all of the businesses in an index and then overweight or underweight those businesses in index. We don't think that's the case. We think the approach that has worked for us for the last 10 years is to invest only in what we think we can predict, which are recurring revenue businesses. Those would be software companies, credit bureaus, subscription entertainment businesses like a Netflix, that kind of a business where we know revenue will be there over the next couple of years, and it's easier for those businesses to run and manage and compound free cash flow. From an investor's perspective, we think that means that they can receive a more predictable, durable equity return over time with less fluctuation. It also means that the management teams of our companies will have more confidence to invest in growth projects because they know the revenue and free cash flow will be there over the next couple of years. So it gives them a chance to outperform. That's why we like this approach, and that's what we think RW offers to advisors and investors.
And tell me more about a name like HEICO. HEI is the ticker symbol. Why is this a name that you think is benefiting here going forward?
So what we see is a super cycle in defense and in defense spending. And when we look at the NATO countries in Europe, their spending is projected on defense to go from $400 billion a year this year to $1.4 billion a year over the next 10 years. That's a more than tripling over the next 10 years. And so from our perspective, we're looking for businesses that will benefit from what we think will be a very enduring trend, but also fit our recurring revenue investment approach. HEICO is the perfect company that fits both of those themes. It's highly recurring because it sells aftermarket replacement parts to the defense industry across the background of the defense industry, and they will significantly benefit from the growth of European defense spending and U.S. defense spending, though that will be not as robust as the European defense spending will be. So we like HEICO very much for that reason and many others.
And LOAR, LOAR?
LOAR is a company that is an acquirer of aftermarket aerospace parts. They will also benefit significantly from the growth in European defense. They're, as a matter of fact, acquiring a supplier to the European defense industry as we speak. But LOAR is really one of those companies that was a private company for the last 12 years, run by a great CEO named Dirksen Charles, and has grown at 30% a year every year, or on average when it was private over the last 12 years. And we think it can continue to grow at a 20+% rate for a long period of time as it acquires other aftermarket aerospace parts suppliers, and it benefits from this defense, what we would call defense super cycle. It's maybe not as hot as American Eagle with the advertising campaign that they have going on, but it is really well positioned, we think.
Yeah, understood. As far as the Mag 7 names, do you have a favorite in that group? Do you like to have some of those names or not necessarily?
Yeah, absolutely. We've owned Microsoft because it certainly is one of the most recurring revenue businesses on earth, and clearly is benefiting and is really in the catbird seat when it comes to benefiting from AI. It's using all of the technology that AI has enabled to improve its products, reduce its costs, and obviously grow substantially on the Azure side of their business. So we think Microsoft will continue to be able to add innovations and Copilot-like products to its suite, price up its product, and continue to grow its unit volumes on the Microsoft 365 side. What is unbelievable is I don't know anybody that doesn't have Microsoft 365 or Office, and yet Microsoft is growing its units and seat count at 6 to 8% a year, despite the fact that almost everybody on earth has access to it, but clearly there's still opportunity to access individuals that are not subscribers yet. So Microsoft is growing its customer base. It's growing its prices. It's increasing prices over the years as it adds innovation, and it is obviously clearly a huge AI beneficiary. The second business is Broadcom, and clearly Broadcom is delivering huge orders on its XPU business, and clearly that has multiple years of growth ahead. So we're very bullish on both stocks.
All right. It's good to chat with you, Joseph. Joseph Shaposhnik, founder, portfolio manager, Rainwater Equity. Thank you very much.